Welcome to the SoFlo Real Estate Show. Ask Athena anything, your go-to podcast where we answer all your burning questions about all things in real estate, especially here in South Florida. So whether you're a first-time home buyer, a seasoned investor, or just curious about the market, we're here to give you advice and insider tips. By the way, if this is your first time to the Real Estate Show, be sure to like and subscribe to get notifications of upcoming episodes. My name is Athena Barrocas. I'm your expert realtor. And joining me today is our financial expert, Greg Wareham of the Federal Savings Bank. Welcome, Greg. Happy to have you here.
Thank you so much for having me today, Athena. It's great to spend time with you and your audience, and I'm looking forward to doing this together.
I'm excited to have you. There's been quite a bit of anticipation, Greg, from buyers that lower interest rates are coming soon. I mean, they are on the bench waiting for lower interest rates. But as I'm looking at the information of all the key economic indicators and what's going on with our new administration, some of the geopolitical stuff on the horizon, I'm not seeing lower rates coming soon. What are your thoughts?
Yeah, I couldn't agree with you more. And most experts would say that interest rates are probably going to stay in that 6 to 7% range for 2025. And part of it's geopolitical, part of it's just kind of overall uncertainty until the new administration settles in. Now, that's not a good or a bad thing. That's just a result of any new administration coming in and the balance of power between them, the Federal Reserve, and the different things that are going on. But I'm thinking 6 to 7% is probably what we need to plan on this year.
And you know what? That's okay. Let's just plan on 6 to 7% and not pay attention too much to all the headlines out there. But as we plan for the 6 to 7%, there are some strategies that buyers can use in order to make their loans more affordable, maybe buy a little extra in their homes. And I believe that you're going to be able to share some of those strategies with us later today.
Oh, no question. We're going to review some different strategies to give you a little taste of that. It all first starts with education, number one. And then two, just understanding the options, what you can do to get that payment down, both short and long term. So I'm looking forward to going through that with everybody.
I'm looking forward to sharing those secrets too with our audience. But let's kick off things first by examining the current landscape of the mortgage rate. Over the past year, we've seen some fluctuations. For instance, the average 30-year mortgage dropped a little bit under 7%, and then it hit its lowest point in December, and then it was right back up in January. So we're seeing a lot of fluctuation in the mortgage rate. Can you talk to us a little bit about that?
Yeah, certainly. And everyone got, I think, really optimistic when rates dropped in November, December. This is a new trend that we're going down. And then we saw them just start to pop back up again. Part of that was just the anticipation of an election and the new administration, right? So the market has a tendency to react to what they think's going to happen. And as a result of that, you can see interest rates drop. So the market believed that Trump's going to get into office, things are going to change very quickly, and staying ahead of that, the market reacted to it. Well, as we see, as it gets into the administration, rates started coming back up again. And again, kind of alluding to the uncertainty we were talking about before, as things start to stabilize out, we'll probably see good things happen.
I agree with you. We just have to wait for a little stabilization, a little bit of calm, and getting back into what we do best, and that's helping buyers and sellers transact. But this isn't just real estate. I mean, we're talking about all different levels of credit, where we have interest rates, whether you're looking at buying a car, your credit cards, and so forth. I think one of the biggest misnomers or the biggest misunderstandings out there is the difference between short-term and long-term interest rates and how they move. It is a very complex reality. And you being the expert in finance, I know you're going to be able to shed some light on this for us.
Well, thank you for laying it out that way. I appreciate you. Yeah, short-term and long-term interest rates. The thing that the consumer or the public generally hears about is short-term interest rates. That is the interest rate that the Federal Reserve sets. And that their interest rates hovered between 4.25 and 4.5% at the end of last year. Now, when the Federal Reserve increases or decreases their interest rates, it does have some impact on long-term interest rates. But directly what that impacts are things like car payments, home equity lines, credit cards. So, point being, when the Federal Reserve drops their interest rates, if you have a home equity line, generally your home equity line interest rate and payment's going to go down that following month. What it doesn't directly impact are long term interest rates. And it's not that it doesn't have a lot of influence over them, but it doesn't have a direct correlation. And when we talk about long term interest rates, we're really talking about things like a 30-year fixed interest rate mortgage. Now, when the Federal Reserve makes a change, that's a positivity for the marketplace. And what you start to see fluctuate are things like the 10-year Treasury bond yield and the mortgage backed securities market. A great insider tip for you is if you want to know what's going on with long term interest rates, 30-year fixed interest rates for a mortgage, pay attention to what's called the 10-year Treasury bond yield. And it's published everywhere on every major financial site. When that yield's going up, generally long term interest rates are going up. Yields going down, generally long term interest rates are going down. Now, to put it into perspective, during COVID times, that 10-year Treasury bond yield was 0.5%, historically low. And as a result of that, you saw interest rates historically low. When you look at where the market is at currently, it's at about 4.5%. So it's an 8 times minimum increase from where it was to where it is currently. And that certainly forced
Wait a
long-term
minute,
interest
eight
rates up.
times?
8 times.
Eight
Eight
times?
times.
That's crazy.
Eight. I mean, it's crazy. I think
I mean,
that
when you really put it in perspective, that's a big impact to where our consumers were, a couple of years ago with free money and where they are today.
yeah, I mean, and it's changed obviously the affordability for everybody. Now, was it necessary to do that from a Federal Reserve standpoint? And the Federal Reserve, and they're bigger experts than me on this, obviously, would be yes, because rates were so low, inflation started to jump to significant highs in a very short period of time. And short time changes like that are dangerous. And in order to stay ahead of that, that's why you saw the Federal Reserve increase interest rate time and time and time again to really hedge off against inflation. And they've done a good job in getting inflation down. Now, the other indicator that drives long term interest rates is what's called the mortgage backed securities market. And as a consumer, you never see that. You never really hear about it. But the mortgage industry behind the scenes is kind of complex. These mortgages are bought and sold in big blocks, not one mortgage, two mortgages. You're talking hundreds of millions of dollars of mortgages that are sold. And it's really a bond market, and that drives interest rates. I'm going to give you a quick example. So let's say that the bond for a particular mortgage backed security is at 6% today. Well, that doesn't mean that the lender can lend at 6% or the bank, because if they did that, they'd actually lose money because that's the cost of that bond in any given day. And you still have a staff, you got everything that goes into processing a mortgage. So let's just say, as an example, that you have to lend out at 7% to create some profitability. Great, everyone's making money. Now, there's a value associated with that 6% coupon rate. And let's just say it's worth $1. If that value in any given day goes from $1 to $1.20, oh my gosh, that's great. These things are making more money. And when they're making more money, interest rates come down because the loan instrument's more profitable. On the flip side, say that dollar bond is worth 90 cents. That's bad for everyone. People are losing money, and that cost gets transferred back to the consumer, and interest rates go up to try to offset that loss. So,
Right. And that's not visible to the consumer at all.
no, it's
The
not.
activity of the mortgage backed securities, the MBS, not visible, not transparent to the consumer.
I mean, there's a lot going on behind the scenes
Yeah,
to
there's a
make the market
lot.
work, right? I mean,
Yeah.
trillions of dollars, going through
There's
the
money
real estate
flowing
market.
everywhere and there's things going on. So I like the fact that you said, all right, short term interest rates, exciting. It kind of spurs a little activity, makes people feel good if it's in the positive direction, creates a little panic when it's not. But if we're looking at buyers who are taking out a 30-year loan or a 15-year loan or buying a home, they shouldn't really be concerned so much with what's happening at the beginning. They really should be looking at the 10-year treasury bond. Is that
That's
correct?
Absolutely, Athena. And that's
Okay.
really what you want to pay attention to. And you have to talk to your advisor as well. Talk to your loan officer. Talk to a person that knows what's going on in the marketplace so they can better educate you as to what's going on currently. With that, there's no crystal ball, right? You don't know where interest rates are going to go. But a couple of things to keep an eye on is the consumer price index. That can impact that 10-year treasury bond yield. Unemployment's a big one. Keeping in pace with that unemployment rate, because all those things impact the market in that 10-year treasury bond yield.
Yeah. And you know what's interesting, Greg, is that, we're so as a culture now, we're always looking for that immediate answer. What's the fastest answer to solve a problem? And this, I believe, is one case when we're looking at something as complex as the movement or understanding how interest rates are impacted, that a buyer really needs to have a team around them. They need to have a good financial advisor. They need to have a good lender. They need to have experts that they can pick up the phone and say, hey, what's going on in the market today? I'm still thinking about buying a home. Is this a good time? Are the indicators in my favor? Really, I'm a huge proponent. Have your team, have your lender, have your real estate, have your, wealth advisor. Your seat dial into people that really know what they're doing and understand things that it might be a little bit bigger than a news hit.
Absolutely. It's critical. It really
It's
is critical in all aspects of life.
It is critical. You're absolutely right. Well, thank you for sharing that. And we'll definitely put the link to some of those ideas you have. So that way our viewers and our audience can definitely follow some of like the 10-year treasury bond, maybe something else. But we'll have some links on the bottom for you. But what I want to kind of move on to now is because I think it's just fascinating. We got the new administration in. And we're all like back on the bench and we're going, what's going on with interest rates? Because we've heard through the headlines, through some, I was going to say tweets, but I'm not sure what we call that, X's. And so what's going on? We've heard Trump come out with some of his ideas on how he's going to impact tariffs, what he's doing with his policies, his new administration. And, some of these economic policies and these tariffs could impact our housing market. And I was wondering what your take is on that.
Yeah, there's no question about that, Athena. When you look at tariffs, tariffs are kind of like a tax, right, on goods that are coming in. So if we're purchasing or acquiring goods from overseas and we put a tariff on it, increase the cost of it. Well, that cost isn't getting absorbed by the country that's sending it. That cost is getting absorbed by the consumer. So if the cost of lumber, as an example, goes up, well, all right, it's more expensive. It's more expensive to the builder. It's more expensive to build the house, which makes the house more expensive. The other thing that it does in a bigger scheme is it increases inflation, right? Because when costs go up on anything, that really means inflation. As inflation goes up, as we were chatting about before, well, the Federal Reserve doesn't like that. And that could put the Fed in a position where they're not going to decrease the short term interest rates. So I'm not qualifying whether or not the tariffs are bad or they're good, because it's probably somewhere in between, right? Depending on the side of the aisle that you're looking at. What's really important is just to understand what's going on.
I agree. We're not here to judge. We're here to help explain what's going on and why, we're looking at from your perspective, my perspective, why we're saying the interest rates are probably going to stay between 6 and 7%. And we're not really seeing that dialing down. It's just true. Tariffs, costs of construction, home improvements, all of that becomes, because we're such a global economy, right? All of that impacts the cost of home ownership, and it could impact your mortgage payments. I mean, builders are going to cost more to build, and it's going to have an impact, but neither good nor bad. It's just the reality of it. So I think it's important to understand it. But given these complexities, Greg, let's talk about some strategies homeowners can employ to help navigate this environment.
I say the first thing that we've been talking about is the educational end of it, right? You have to be in the know. What's going on with inflation? What's going on with the Federal Reserve? What's going on with unemployment? The great thing about having information at your fingertips today is that if you use it the right way, you can make the best informed decision for yourself. So number one will always be education and staying on top of that. So number two, you got to understand your options, right? And I'll give you an example. So I was talking to someone yesterday who's looking to lock their interest rate in, and the prevailing interest rate for their particular situation was 7%. It was based on their credit, and it was also based on how much they were putting down. So we looked at that, and there was a $500,000 loan amount for them. So we looked at two options. At 7%, you could pay 0 points on the loan. And we throw around that term points. Really, what a point is, it's a percentage of your loan amount that's used to buy down that interest rate. So we talked about, well, you can pay a point, and that would reduce your interest rate from 7% to 6.75%. Well, that's a good thing, right? Now we're in the sixes. Well, time out. Let's look at the details and the math on everything. So on a $500,000 loan, the difference in monthly payment between 7% and 6.75% is $83 a month. Okay. It's good savings, not life-changing savings. You also have to keep in mind that $83 a month may be tax deductible for you because it's mortgage interest. You check with your CPA, but it very well may be. And then we had to look at the cost. So the cost of paying 1 point on a $500,000 loan amount, 1 point equals 1%, is $5,000. $5,000 to save $83 a month. Well, what's the break even on that? So if you take $5,000 divided by $83 a month, it takes you about 60 months to recuperate that. 60 months, 5 years. So the bet that you have to make as the consumer from an educated decisioning standpoint is, do I think I'll refinance my property within 5 years? If the answer to that question is yes, it would never make sense to pay the point. If the answer to that question is no, it would make sense to pay the point because you'll always win long term with the lower interest rate. So you really need to go deep on those numbers. And that's a strategy that I don't think is used enough in the industry to really understand the math, not the emotion. What's the math? The other thing that I would talk about, or final thing that I would mention, is the 2-1 buy down. So I don't know if you've ever heard of it before, but here's essentially how a 2-1 buy down works. So let's say that for that same consumer that the prevailing interest rate is 7%. So what happens in a 2-1 buy down is in the first year, interest rates 2% lower, so 5%. At the end of that year, it goes to 6%, and at the end of the second year, it goes back to 7%. All right, well, what's that mean financially? And I'm going to change our loan amount a little bit. So let's say it's a $600,000 loan. At 7%, the mortgage payment, principal and interest, is $3,991 a month. Okay. Well, what if my starting interest rate is 5%, 2% less, 2-1 buy down? That changes your principal and interest payment to $3,220 per month. Well, that's great. That's $771 a month difference in monthly payment. After that time frame, excuse me, and you have that for 12 months. So that equates to about $9,500 in savings over that first 12 months. Year number 2, you're into it. Rate's now 6%. Your principal and interest payments $35.97 a month. That means you're saving $394 per month as compared to the 7% interest rate. Over a 12-month time frame, that's about $5,000. So after that, your rate's 7%, you're back at that original payment. So what's it save you? Landing the plane.
You land that plane, Greg. Do the math. Do the big math for us.
So it saves you $15,000 in mortgage payment.
Wait a minute, let's just stop there for a moment. 2-year buy down, $600,000 loan, and you can save how much?
About
potentially
$15,000 in interest.
$15,000 in interest. And at the end of that 2 years, depending on where the mortgage rate is, the possibility of refi comes into play too.
And that's the bet that you're making, right?
Yeah.
Because on that 2-1 buy down, that's going to be paid by the seller. It's going to be paid by the builder. And if you have that $15,000 to work with, you got a couple options, right? Do I take the money? Do I drive my interest rate down just by paying points longer term? Do I do a 2-1 buy down? Again, it's education. It's understanding your options and what's best for you in your individual scenario, because everybody's is different.
Oh, yeah. I was working with a buyer just recently. It was $1 million purchase, right? Which isn't unusual for South Florida. It's $1 million purchase. And, we got into the discussion of repairs. Okay. So they're like, oh, I want like, $20,000, blah, blah, blah. Okay. So I said, wait a minute, let's talk to the lender, because $20 in repairs came out to be over the life of the loan, if we looked at it that way, apples to apples, it was only $97 a month, Greg. And like $97 a month, that's like 2 lattes a month for you for 12 months. That makes no sense. But let's look at a buy down, right? The difference was $225 a month for that buy down. So that's a big difference.
Huge
And
difference.
yeah, because that 225 is per month for a very long time. That is a big difference. So being educated, understanding options is incredible. I want to go back to what you said earlier because this is really important. Everybody's like, oh, I want to buy down my interest. I'm thinking, I'm going to pay 2 points off of this thing because they feel that, that initial mortgage payment might be a little bit high, and I get it. But when you're paying down your own interest rate, what you're doing is just paying your interest up front for those periods of time. It's not like you're really saving any money. You're paying your interest up front. And then what is the break even point? Most buyers do not make that break even point, right?
Yeah, I couldn't agree
Most
with
of
you
them
more. Yeah.
don't. And so I'm always like, if you need to do it, of course, right? If you need to do it, of course. But if you don't need to do it, let's look at some other options. Let's look at some other strategies. So the buy down in today's market, Greg, is phenomenal. What we have today that makes it work is we have a stagnant market for overall. We have longer days on market. We have sellers that know that they have to pay a little bit of the buyer fee commission. They know that they have to pay credits on work or on the inspection. These are all costs they anticipate. So why not take that and put it into your mortgage instead? In today's market, that strategy is working. So I love these options. I think you're spot on, Greg. In today's market, these are perfect options.
Yeah, and again, it just comes down to education, and it's not a one size fits all. You really need to understand where you want to be short, long term, and have that numbers oriented conversation to get you where you want to be. I mean, let's face it, rates are higher than any of us want them to be right now, but they are what they are. So, how do we have a strategy short term to offset that, understanding long term that statistically they're not going to stay here forever? And there's always an opportunity to be able to refinance them.
Absolutely. I remember, my I remember our parents, you're about my age. Remember the 18%, the 21%? I mean, if our buyers are trying to experience that right now, oh my goodness, 6% really isn't that bad. 6%, I think, is a healthy number for an interest rate to run the economy. So we just have to help educate and make the process feel a little bit better. Well, Greg, you walked us through some really complex topics earlier, but we have a few questions that I would like to ask you on behalf of our buyers and our audience and trying to go there. It's about 5 questions. So if you're ready, let's
Sure,
get to it. Okay.
let's go.
All right. Well, here we go. How often do mortgage rates change?
Great question. So they change, generally, they're going to change daily. Now, what you see in the mortgage industry is interest rates update somewhere around 10:30 Eastern time every day. Now, you can see some fluctuations throughout the day if there's particular volatility in the marketplace, either positive or negative. Remember, I talked about the mortgage backed securities market? When that thing's super profitable in a day, rates may actually improve over the course of the day. Reverse is always also true. If that coupon value really drops in any given day, rates may get negative in that day. So you can count on an update every day. It doesn't mean they're going to change. They may stay flat from the day before, but you do get an update every day.
Okay. So daily changes. That keeps everything moving. All right, here we go. It talks a little bit. This is a great question. And it's right on par with what we were discussing earlier. Can tariffs directly increase my mortgage rate?
Directly, I don't know that I would say directly. Indirectly, they have the potential to increase your interest rate. Kind of like we were chatting about before. If longer term those tariffs impact the cost of goods, which increases inflation, it could have a negative impact on interest rates. But this is a huge ship, the United States. And even though it's got a big rudder, it doesn't move that fast. So you don't see a tariff negatively impacting you in a month. I mean, that's a long term process if it had any negative impact to the consumer.
Okay, here we go. Is now a good time to buy a home considering current mortgage rates?
I get this question all the time, and I can give you my opinion. So it does depend on your individual situation. It can be difficult to purchase a home right now if you do not plan on staying in it for a long period of time. Or I should say, not holding it for a long period of time. If you're trying to play the market to buy something and sell it in a year, that could be a tough strategy unless you do that for a profession, right? You may not. That's a hard moneymaker currently. But I will say this, longer term, it always makes sense to own versus rent because of the tax benefits associated with it. And even if that mortgage payment is higher than what you want it to be currently, you always have the opportunity to refinance. Now, let's say you were waiting for interest rates to drop to 5% before you buy. Interest rates drop to 5%. Well, what does that do to the value of real estate? Now homes have become more affordable. And as they become more affordable, does that organically force the prices up? So those are the things you really need to pay attention to if you're deciding to sit on the sidelines. I talked to a lot of people that decided to sit on the sidelines in 2022, as you have, Athena, and it wasn't the best strategy. So I'd really base
Waiting
it on
is
need.
never the best strategy. I mean, I say this all the time. Waiting is the worst strategy you can have as a buyer or seller. You just have to jump into the market. If you look back, right, Greg? If you look back 10 years ago and look at a house that was bought 10 years ago, it doesn't matter what house, where it is, anything. And you go 10 years forward, especially with our unicorn years that nobody anticipated, that house is, maybe about 70% in value. It's incredible, absolutely incredible. So yes, I agree with you. Waiting's the worst strategy out there.
It comes back to the math. And just real quick before we hop off this one. So if you look since 1990, the value of real estate has increased average per year at 4.5% year over year over year over year. Now, yeah, there was a crash in 2008 to 2010, and that warped the numbers. But even when you take that into consideration with the aggressive growth that we've had, it's 4.5%. Here's what you may not know. What's the average increase to rent over that same time frame
Oh, I
nationally?
don't know. What is it?
6.2%. So the increase to rent has outpaced the increase in value. So if you got digest that one for a second, I
Yeah.
could be making 4.5%, or I could be paying 6.2% more year over year statistic.
That's incredible. That's incredible. That's why home ownership is so desirable. All right, so here we go. How can I secure a favorable mortgage rate? What does someone have to do to get a favorable mortgage rate?
It really comes down to credit and down payment. So you want to make sure that you keep your credit score obviously as high as possible. How it works behind the scenes is the highest credit that you can have to get the best possible interest rate is a 780 credit score. If I go back a couple of years ago, it used to be a 740, but that changed. So now it's a 780. So that's one part of the equation. The other part is down payment. So the more money that you're putting down, generally the better interest rates you're going to get. I'm going to give you a quick example. 780 credit score with 5% down. And the other person has a 660 credit score with 50% down. Who do you think's getting the better interest rate?
I'm going to go with buyer number two.
Buyer number two, exactly. The person with the 50% down, even though their credit grade is lower, is most likely going to get a better interest rate because they got more skin in the game. And all those factors come into play.
That's interesting. I don't think a lot of our audience would have picked buyer number two. So thank you for that, Greg. So let's go to the last question. This is a good one. Should I consider refinancing if the mortgage rates drop?
Look at the math. So there's a cost associated with refinancing. And let's just say that cost to refinance is $5,000. I'm just throwing a number out there. And it's probably not that far off, maybe 4,000, depending on the title and a lot of fees that go into it. So let's say it's $5,000 and you're looking at it and you're saying, well, how much am I going to save per month? Well, if refinancing in that situation saves you $500 a month, I think it's a no-brainer because you recuperate that $5,000 in 10 months. Now, say it saved you $100 per month. Well, that's a 50-month break even. That's a pretty long break even. It may not be in your best interest, and you may want to wait till rates continue to drop.
This was a lot of really good information. I mean, we went from geopolitical all the way down to the three best strategies. And then we were able to answer some really important questions from our audience. So, Greg, I just want to say thank you so much. It's always great to have you here, have your insights and helping us navigate the housing market, which is a very, very, very complex engine.
Thank you so much for having me, and I appreciate everyone out there listening today. Look forward to being back in the future.
Love to have you here. Well, everyone, that's it for our episode today on the SoFlo Real Estate Show. Ask Athena anything. Stay tuned for more updates and insights into the real estate market, especially here in South Florida. We'll talk to everybody soon. Bye. Thanks, Greg.
My pleasure.